And it is time for Talking Numbers. Earnings will really help set the tone on Wall Street this week. A number of big names are due out, including results from Yum Brands tomorrow. PepsiCo and Alcoa both reporting on Thursday. And then it's off to the races. Overall, Wall Street is expecting growth to be a bit slower in the third quarter. Consensus earnings per share for the third quarter is $20.46 a share on the S&P 500. That's about 75 cents lower than last quarter, and it marks the first time quarter-to-quarter growth has slowed since it began climbing in 2009. As you heard earlier in the program, we're expecting earnings to grow, but revenue to be somewhat flat. What does the earnings slowdown mean for equities? Here to tell us on the telephone is Pankaj Patel. He's Managing Director, Quantitative Strategy with Credit Suisse. Good to have you on the program. Thanks so much for calling in.
Thank you, Maria.
Let me ask you about the slowdown in growth and what that may tell us about the equity markets. Can you tell us what you're seeing right now?
Yeah, what we see as you mentioned, we expect this will be the first quarter of slowdown in earnings growth cycle, which began in June 2009. We look at the previous 4 such instances of slowdown in past 20 years, and we find that with the exception of 2004, this period has been flat to negative for equities.
Okay. And do you expect that we're going to see once again strength in earnings, but not so much in revenue?
Yeah, well, I'm talking about earnings right now, but yeah, definitely the revenues are not growing as fast as earnings. The reason earnings are growing faster than revenue is corporations are cutting down their costs quite a bit.
What's the bottom line, Pankaj, for investors? What should we be taking away from all of this?
Well, an investor should think about sectors, and we would suggest investors should weigh consumer staples, healthcare, and information technology as overweight. For the consumer staples, that goes into the counter cycle of the S&P at the S&P level. For example, the consumer staples growth is negatively correlated for the earnings and for the revenue versus the S&P.
So
the same thing for the health sector. Health sector is similar to consumer staples, whose earnings and sales are negatively correlated with the S&P 500 overall as an index. And information technology, we have seen increases in EPS, and the revisions have been increased for the from the beginning of this year through now for the technology sector. We believe this sector is ripe for potential merger and acquisition, as tech companies have quite a bit of cash on their balance sheet.
All right, we will leave it there. We so appreciate it, Pankaj. Thanks so much.
Thank you, Maria.
We will see you soon.